Excellencies, ladies and gentlemen, let me begin by saying what a great pleasure it is to be back here in Istanbul, to attend the Istanbul Development Dialogues, and to do so particularly with the focus that we have chosen for this year's theme, financing the SDGs. Listening to Mr. Naji Akbal just now, I think you are left in little doubt how much the question of financing literally permeates every aspect, not only of government, of public policy and of budgeting, but literally of every part of our national and global economy that is in the midst of profound transformation. And I want to thank Mariana, you, and through you, the Regional Bureau and the teams here in Istanbul for having prepared a dialogue that I hope will not only note the challenges, but in fact dwell on some of the ideas, the solutions, and above all, the partnerships that you also spoke to just now that will take us forward. But finance, at this moment in history, is a very strange thing. We live in a moment in time where the world has, in terms of wealth, accumulated over $300 trillion worth of wealth. This is the richest moment in human history, at least in terms of finance. But it is also a strange moment because in some parts of the world we now have to pay the banks to actually deposit our money. You don't earn interest, you actually pay for the privilege of just having your money deposited. We are able to raise bonds on an unprecedented scale, particularly also the emergence of green bonds, and it shows how our global financial system and its actors are able to respond with new services, with new products. And yet we also live in times of financial volatility that force governments, particularly in emerging economies and developing countries, to set aside billions of dollars simply in order to hedge against currency devaluations. Billions that could be used to invest in development, but that are simply maintained in order to protect a national currency against the vagaries of our financial market. We are facing major global imbalances in our financial system. I regularly attend on behalf of the United Nations the finance ministers and central bank governors meeting of the G20. And I can tell you, the outlook is one of increased nervousness, of uncertainty and volatility, where particularly the emerging economies are already paying the price for what is an uncertain prospect for our financial system. So as we dwell on the strength and weaknesses, or perhaps the positive and the negative sides of our global financial system, we need to acknowledge that it has delivered remarkable things. But it also delivered a financial crisis that brought us almost to the precipice of global bankruptcy just a few years ago. You would be forgiven for wondering whether that incident really happened, because if you look to the stock markets of the world, it took them less than 3 years to recover their pre-financial crisis levels. And yet our national governments and also our treasuries had incurred debts that to some extent will still be paid off by the next generation in terms of having to bail out that financial system. I mention this because that is the context, and it is also the product of a time in which, particularly from the 1990s into the early 2000s, we really did think, particularly if you adopted the transatlantic narrative on finance, that it was the financial markets that would help propel our nations, our global economy, our communities, our energy infrastructure, transport infrastructure into the 21st century. And yes, there are good reasons to say, in part, that was happening. And just listening to you again, Mr. Naji, it is very clear that in an economy like Turkey, the evolving financial system is fundamental to what happens next in Turkey. But what you also pointed out is that it is not only the financial markets that define how financing will work, how financial markets will function, and indeed how our national economies can access financing. Because one thing is very clear across the globe, whether you are a least developed country, a middle-income country, or a highly industrialized so-called wealthy economy. Public budgets are not sufficient in any country to finance the volume of investments that are now clearly needed in order to advance our economies, whether through the lens of responding to the fourth industrial revolution, the advent of the digital economy, of artificial intelligence. You can use many different lenses, but what is quite clear is that whether in terms of physical infrastructure, human capital, or indeed developing new business models and markets, we are going through a period of profound transformation in which the tax revenue base is just perhaps 1/5 of that economy of investment that we are looking at in terms of financing. It is also a period of profound transformation if you take the climate challenge, because literally over the next 35 years, we will need to radically decarbonize our global energy economy. This is not only a public policy challenge, it is above all an investment challenge. It is no longer a technology challenge, it's not even an economic challenge anymore. It is principally a financing challenge. But a financing challenge that the markets are struggling to transact right now, because if you look to the financial system, you have to ask yourself, how can a global economy of finance be aware of everything that we know today about climate change and still be capable of investing significantly more in fossil fuel development, whether in terms of exploration or indeed in terms of marketing and infrastructure? But, should it surprise us? Because in fact, as the IMF just a few weeks ago published in a report, governments currently subsidize fossil fuel consumption to the tune of roughly $5.9 trillion US. This is the estimated amount for the year 2018. This is the signal that we not only provide to consumers or to industry, but indeed to the financial markets. So, colleagues, we live in strange times where our financial system is under stress, where our economies are under stress because finance is not necessarily investing in tomorrow's economy, it is investing in today's and even in yesterday's economy. The alignment of that $300 trillion of wealth that is actually desperately looking for places and spaces to invest in is to some extent paralyzed at the moment, because there is a great deal of uncertainty in our financial markets, and also because our world remains a very unequal one. If you happen to be a resident on the highway of global finance, and we know the countries, we know the economies, we know the capitals in which finance is transacted, you may be forgiven for wondering, why are things so difficult? But at least you have capital parked there. But the vast majority of our countries, economies, territories are not on the highway of global finance. In fact, they're often very far from it. And therefore the challenge is one of development, but also of development under very unequal conditions, and of development against the backdrop of extraordinary uncertainty. What I'm trying to get at is, can we make a connection between the 2030 agenda, the Sustainable Development Goals, and those financial markets, those assets, that international global wealth of $300 trillion, or is it illusionary? Well, I think one of the reasons we're meeting here in Istanbul with this theme is that, in fact, the SDGs are emerging as a remarkably interesting framework through which to not only think about development in terms of universality and integration and these 17 goals that humanity has set itself and the General Assembly adopted unanimously in 2017 to guide both global and national decision-making about development. But what is interesting is, if you turn the SDGs upside down for a moment, they're actually the world's risk map about the future, which is precisely where financial markets are looking for, first, orientation, and secondly, mitigation. Because finance is a very shy commodity, as we all know. It loves certainty, stability, rates of return on investment that are promising. It dislikes and it positively avoids uncertainty, areas in which it is not familiar, and where incentives seem to at least not compensate for the higher risk of investment. In certain areas, the SDGs already today seem to be having a remarkable impact on the discourse in financial markets. In my perception, it is unprecedented the degree to which financial sector players are today, in fact, looking at the SDGs, first of all, as a way of interpreting the future of our economies. Indeed, if you do look at the 17 goals for a moment, they are an excellent expression of all the major Achilles heels of our economies, our societies, and indeed the global financial economy, that if left unaddressed, create precisely those conditions which capital dislikes intensely. So what we did in 2015 was to understand those risks, but also to formulate goals. If those goals can be attained, if countries can move forward in terms of their nations in actually achieving the indicators and targets on these 17 goals, then the logical consequence of that is that investing in those economies becomes a lot less risky, a lot more attractive. And here is really this debate that we currently have between public policy, which is fundamental to defining how financial markets are able to deploy their assets today, how they may view tomorrow's economy, and how public policy and financial markets, whether investors, shareholders, whether it is through the investment of a public-private partnership, as you just addressed, whether it is through funds, equities, shares, bonds, all of these could become major drivers to help us accelerate transitions and transformation. The United Nations Development Programme, as part of the United Nations family, sees it as one of the major areas in which both governments are requesting us to engage and also to assist them in addressing precisely this question. What is smart public policy in the year 2020 when it comes to multiplying the investments that are needed? What is smart public policy in 2020 as compared to 1990 when engaging the private sector meant privatization, which clearly had some benefits but also significant risks? Leveraging additional private capital into delivering the SDGs cannot be synonymous with privatization. We have moved far beyond the scope of that. What it is, it's about alignment of public policy goals with economies within which private capital can invest, achieve a rate of return, bring its entrepreneurial and innovation competence, but at the same time help nations to deliver on these public policy objectives. It can also not be the kind of Wild West bonanzas of borrowing and pushing money into economies that led to the debt crisis of the past. We are already in the year 2019 facing an unprecedented level of indebtedness, and for the first time at record levels, not through public debt, but private debt. This is part of the consequence when we say let the private sector, let private capital drive our economies. For the IMF, for the World Bank, for the G20, for central bank governors, in many parts of the world we have reached levels of private indebtedness that are material to the stability of national economies. So again, smart public policy, the kinds of partnerships, the kinds of economies that we can help to shape, into which the alignment of private capital with public policy objectives becomes possible, feasible, attractive, but also not undermining the stability of national economies, is fundamental to us being able to answer the question of can the SDGs actually be financed? And here, let me remind you also for a moment that, and the UN and the World Bank and many of our international institutions, we are part of this narrative. We talk about trillions of dollars of extra investments that are needed. And indeed, these are the magnitudes within which we are analyzing the investment horizon. But let me remind you that the challenge for us is not to have to print new money or to unearth under some institutional rocks these trillions of dollars that need to be brought into the financial system. No, what we are talking about is to redirect through incentives, through the right public policy environment, through also a different notion of co-investing in outcomes, capital that is currently invested in the economy of today, when really we needed to transition to investing in the economy of tomorrow. Mr. Nagy, you mentioned healthcare. What makes it so difficult, even in the year 2019, for us to envisage a collaboration between the national government that, in line with the World Health Organization's objective, wants to extend universal health coverage, and yet in many of the poorest countries of the world, we know that public finance simply is unable to underwrite this at the moment? What stops us from engaging with insurance companies, taking advantage of their service and product models, of their algorithms, to be able to introduce micro-health insurance schemes that maybe are subsidized initially at a level of 20 or 30% by public funding, but actually allow the strength of health insurance providers to become a way of rapidly extending the capacity of poor people to actually pay for their health costs? Because one of the more sobering statistics in the work of UNDP when it comes to poverty reduction is that 40% of those who escape poverty fall back into poverty. And more often than not, health is one of the major reasons for it, because none of us will refuse to take the last savings we have to ensure that our parents, our siblings, our children receive the treatment they need. It is one of the tragedies of poverty eradication and the development story of the 20th century that we could have actually moved far further along already in poverty eradication if only we had had more intelligent ways in which to design public-private sector collaboration along these objectives. For us in UNDP, this is the moment in which we must rethink also the way that we are of relevance, of use to you as our partners, as our member states. It is for this reason that I, just a few months ago, established the Finance Sector Hub in UNDP. It is why last year I commissioned a longer dialogue with finance sector players to try and understand better what role could UNDP play in working with governments to help, for instance, expand the space for impact investment. Again, you spoke to it. And we learned a great deal which pointed UNDP precisely towards that area that actually is the way to unlock investment, and that is impact. So if impact investment suggests that we want the private sector to massively expand its investments in this field, then the private sector, basically those players in the financial markets that have been trying to push this boundary, tell us that the problem is that we actually really struggle in identifying the impacts, in measuring the impacts, in having impact intelligence, and therefore we need the help of development and public institutions to be able to translate impact into something that our investors can appreciate. Because the problem today in many banks and funds is no longer a clientele, i.e. those who put their money with those institutions who are not interested in impact. It's the opposite. The pressure on financial institutions to deliver more than just a rate of return, but at a minimum not to create harm and ideally to contribute to the solution of our contemporary problems, is driving billions of dollars already in the financial markets. One reason why we see so many financial institutions looking at the SDGs and the future of investment through that lens. But it is also in the nature of the SDG logic that governments, and therefore we in UNDP, want to advance the way we look at budgeting, national development strategies, and also planning. Take climate change. If we continue to define investments in addressing climate change simply through the goal on climate change, first of all, we know that we will not succeed in terms of the financing that is required. But imagine for a moment designing a national climate strategy that is not defined only by the targets and indicators of reducing carbon emissions, energy efficiency, but takes access to energy, poverty reduction, public health, job creation, and I could go on. These are all goals in the 17 goals, as integral to the design of the return on investment on climate change. Suddenly the economics from a public policy, a public purse, a treasury, a finance ministry perspective changes fundamentally. And it is remarkable in how many instances across the world today our national planning, budgeting and investment strategies still do not look at these investments from that perspective. So UNDP has in recent years developed tools with which to work with governments, the development finance assessments, but also the tools that allow SDG national planning and design processes to be better aligned with this approach to emerge. We are helping through SDG Impact also to create the kind of conversation between those who have capital and countries and project developers and national strategy custodians for development to identify how that impact equation can be translated from an abstract aspirational view to something that is tradable in a financial market. We are also helping to address through our finance work one of the great tragedies, particularly for least developed countries and smaller economies, namely the lack of fiscal discipline in the sense of those who are supposed to pay taxes. It's one reason why UNDP and the OECD established the Tax Inspectors Without Borders, which now helps countries to audit significant players in their economy as to whether their tax behavior is actually conforming with national tax law. And it is also why, again to pick up on your point, UNDP has been proud to partner with Turkey, with Indonesia, with the Islamic Development Bank, on also understanding Islamic finance. The green sukuk in Indonesia that raised over $1 billion is a remarkable success story. It speaks to the capacity of both traditional financial analysis and development aspirations to actually be aligned with Islamic finance principles, and for governments to be able to tap into this as a major opportunity to leverage and engage the capital that people would like to see for national development, but have lacked the platforms, the institutions, the transactional means by which to do so. Let me conclude my remarks in the context of this particular Istanbul Development Days by reminding us of why this discussion is not just about a next, let's say, chapter in development, but it actually becomes a fundamental determinant as to whether by 2030 we will not only have achieved the SDGs or not, but whether we are collectively as a global financial system and global economy, but also nationally in terms of each country, are able to initiate the transitions that we now know are a precondition for us to look to the future with more optimism than pessimism or skepticism. The financial imbalances, the economic imbalances, the phenomena of inequality, the emergence of climate change as perhaps the single most dramatic threat to life and economic activity and places we live, that we have built up as cities, or the places we grow our food, all of this is actually being put into question by our inability at the moment to respond on a scale and against a timeline that is virtually without precedent in human history. Our financial system does not lack the resources, but our financial system right now is investing in the wrong things. It is often making things worse. In that sense, it is actually amplifying the problem, and public policy is struggling to understand how it can incentivize a financial system to align itself with what clearly governments are increasingly agreed to, namely that these 17 areas we identified through the SDGs are major risks where inaction puts our future at peril. And this is not a debate amongst finance sector specialists or economists or finance ministries alone. This is a debate that is beginning to hit our streets. It is the debate that you find in those communities through the experience of inequality, unfairness, marginalization, are beginning to display the kind of disdain for the current political governance and policy systems we have. It is the children who are going and leaving their schools in order to protest on the streets because they find the inaction of leadership across public and private sector unbearable, intolerable, incomprehensible at this moment, in their millions. Now you might dismiss their children. I don't dismiss them. I find it extraordinary that a young generation of 13, 14, 15 years feels compelled at the moment in their millions to step outside of their schools and look at us and say, what are we doing? So for us, the United Nations Development Programme, this world in which we are currently working and operating is one that is in need of dramatic shifts. We want to consider ourselves integral to your capacity as countries, but also to society's ability to look to the future with a degree of optimism as part of our daily work. The United Nations Development Programme, in its integral part of the UN system's offer, is an offer to you to try and address at national level, but also globally, this question of, can we make finance part of achieving the SDGs, or will our global financial system not respond in ways that will allow us to address the SDGs? If it is the latter, then you can rest assured the year 2030 will perhaps be the most sobering balance sheet that the world has ever undertaken, because it will have failed virtually across every goal. But from where I sit, I think the opposite is likely. I think we are capable. I think we are seeing many significant shifts that are happening in public policy, in the economy, in the private sector. And I think the only thing that we need to realize right now, that we have no time for business as usual. We need courage, we need leadership, we need innovation, we need entrepreneurship. Above all, we need leadership. And this is why, perhaps in this room and through you, we can help to create the confidence in those leaders that will take us forward. Thank you very much.